Hi everyone, in today's video we're going to discuss the security analysis for the lay investor, the general approach, which is chapter 11 of the Intelligent Investor. So for starters, Benjamin Graham discusses the difference between security analysis and financial analysis. Security analysis is analysis that is limited pretty much to stocks and bonds, whereas financial analysis is a little bit more complex and it involves also some kind of work about investment policy, so portfolio selection, plus a substantial amount of general economic analysis about industry, for example. Every security analysis starts from the interpretation of the financial statements, which is another subject that was covered by Benjamin Graham in another book, also called The Interpretation of Financial Statements. So for starters, Benjamin Graham discusses about the bond analysis. For the bond analysis, the most important test is the earnings coverage test, which is basically the chief criterion used by Benjamin Graham for analyzing whether an investment in a bond is sound or not. So the chief criterion used for corporate bonds is the number of times the total interest charges have been covered by available earnings for some year in the past. Typically, it's suggesting 7 years in the past, and this is called the 7-year test. But in the Intelligent Investor, in the chapter 11 of the Intelligent Investor, is suggesting a different test, which can be used as an alternative to the 7-year test, which is the poorest year test. So let's explain the difference between the poorest year test and the 7-year average test. So in the 7-year average test, the test is applied only to the average results over a period of time in terms of earnings. While in the poorest year test, over a period of 7 years in the past or a few years in the past, we take just the poorest year and we see whether it was covered or not. In addition to the earnings coverage test, either the poorest year or the 7-year average test, there are a number of other criteria generally applied, like the size of the enterprise in terms of value of business, the stock equity ratio, and the property value, which, to be honest, experience has shown that it's better to look at earnings power than to look at asset values. Asset values may be of some importance in a few categories, such as public utilities, because rates may very well depend largely on the property investments, real estate concerns that, of course, are a matter of property, and investment companies. So if you use this simple safety test, you can be sure that the bond will successfully face any problems that may arise in the future. Now, for the common stock analysis, Benjamin Graham is suggesting to calculate the average earnings over a period of years in the future and multiply that for an appropriate capitalization factor. Another thing that is discussed in the book is what affects the appropriate capitalization factor. There are a few things that can affect the appropriate capitalization factor, such as the general long-term prospects. In the end, he admits that no one really knows anything about what will happen in the distant future. Another element that may affect the capitalization factor is the management. Even though also here it's kind of hard to devise an objective test to understand which kind of management is important. This is why this factor will continue to be looked at through a fog. Another thing that can affect the appropriate capitalization factor is the financial strength and capital structure of the company. So, according to Benjamin Graham, the stock of a company with a lot of surplus cash and nothing ahead of the common stock is clearly a better purchase at the same price than another one with the same per share earnings but large bank loans and senior securities. Finally, the last two factors that can affect the capitalization factor are the dividend record. Benjamin Graham believes that a company that has a long record of dividend payment, for example 20 years, is a good purchase. And current dividend rate, which from the time the Intelligent Investor was written has decreased substantially, but is still something that can affect the capitalization factor. Right, so thank you for watching. If you liked the video, don't forget to subscribe and watch my other videos about finance and the intelligent investor. Bye everyone.